Hello, my name is John Anton. I'm the steel analyst with IHS Global Insight, and I'm doing a podcast today on setting your steel buying budget for 2011. I've been following the steel industry for IHS Global Insight for about 10 years, and I've been with the company for about 15. IHS Global Insight is the world's largest economic forecasting firm, following such end markets as construction, automotive, as well as the overall economy for most countries in the world. By doing so, we're uniquely qualified to tell you what's going on, not just with steel, but why. If you're buying steel for 2011, your budget for the year should be slightly higher than it was in 2010, probably 5 to 10% higher. What you'll see is prices starting the year low and rising gradually as they go forward. So there are bargains to be had, and if you buy steel at the beginning of 2011 or late in 2010, you could actually have a steel budget that is at or lower than the 2010 average. But as the year goes forward, prices will slowly rise. The rise will be so gradual, it may not be worth buying in advance to pay inventory carrying cost unless you have access to the capital or storage area. There are buying opportunities, but we do think the overall is slightly higher, so you'll probably need to raise your budget about 5%, 10% to be careful. What is the year going to look like compared to 2010? It should be smoother. 2010 started very low, rose very rapidly to the middle of the year, and reached a peak of prices that are some of the highest prices in history. Not as high as they were in 2008, but other than that, some of the highest steel prices ever. Now they're sinking and should sink until the end of the year. 2011 will be more of a smooth rise, starting the year low and rising up. And so it should be a much more controlled year, much less volatile, but still one where prices rise as the year goes forward. Are there risks to the forecast that would change my outlook? Yes. First and foremost, if steel buyers overproduce, you could see lower prices than I expect. You could see a low price risk for the whole year, which is probably the biggest risk, that prices will be on the low side. For you, this is good news. Steel mills have been very careful about overproducing. They do not want excess inventory. They know that right now demand is bad and it's not going to get much better. But if they get too exuberant, if they try to recover too quickly and overproduce, there will be excess inventory, and therefore prices will fall, or at worst, not rise much. For you, this is good news. The biggest upside risk is if China re-stimulates her economy excessively. China is the world's largest steel producer, therefore they're the largest buyer of raw materials. If China starts producing steel at a very high rate, the price of iron ore and scrap will rise, therefore surcharges for steel will go up, and this will push your whole price higher. We believe there is some chance of this happening, but we believe China is becoming more disciplined, quite concerned about inflation, and will not overstimulate the economy. The final point is that we believe there's very low risk of allocation. Your supply side should be good. Even if there's a shortage temporarily at a service center, there's plenty of excess capacity in North America, Europe, and some in South America. If there's a shortage, people can quickly ramp up production and meet it very quickly. There is very little chance that mills will be sold out, so your chances of allocation are low. Overall, a favorable year for buyers, better early than late, but supply should be good, prices should be stable, and you should see a good year. Thank you.